there is a narrative, a potential for gold to rise significantly in the future. And we've talked about the fundamentals even on this podcast for precious metals. But one of the things I wanted to get an update from you on is the potential of gold being revalued and the need, you say, that the U.S. has to revalue gold. What are your latest thoughts on that?
The U.S. debt is rising at a faster pace than GDP, and the interest payments on that debt are rising at an even faster pace. And the reason interest payments are rising faster is we have a lot of debt which was taken out 5, 7, 8, 10 years ago by the government when interest rates were effectively zero. They would have paid 1 or 1.5%. That debt is maturing, and they're having to pay 4.5% for a 10-year bond now. So they're paying maybe 3 or 4 times as much to roll over the maturing debt in terms of future interest. So according to any common sense, but also according to the Bureau of Labor Statistics' own numbers, which you can look on their website and see their future forecast for where how the U.S. finances are going to go, the interest burden is going to spiral and keep spiraling upwards. It won't be very many years, probably no more than a decade, before the interest exceeds the totality of the tax collection. Now, we can argue about when it happens, but at a couple of years ago, we were looking at interest, an interest cost of about 8% of the tax take is now surpassed 14% of the tax take, and it's going to go beyond 22% in the next couple of years, according to the Bureau of Labor Statistics' own numbers. So the interest burden is rising rapidly on a debt, and that's partly because of the maturing debt, but also more importantly, because the debt is rising faster than GDP. So the debt is rising, the total sum of debt is rising faster than they can collect taxes, because if GDP goes up by 10%, they can collect maybe 10% more taxes. But if the debt rises by 20, and these are exaggerated figures, then you've got that extra interest payment on that a much higher debt level. So this is getting out of control. Now, what they can do to solve that problem temporarily, and this could be a permanent problem solving, what they can do is revalue gold that the Treasury holds. The Treasury is the government. The US government holds a lot of gold. They could revalue it to the market value or a much higher value. And I think the argument is strong that they should do it to a much higher value. I picked a bit of a number out of the air and said $15,000 would be a good number. The reason I chose $15,000 was it's the number which will allow them to repay a little bit of debt which is maturing and fund the current year's expenditure. In other words, we can end the year next year with less debt and with having paid all the expenses. But let's just explain how they would do that and how it works. The mechanism is very straightforward, and it's a well-trodden route, so it can be done before. It's been done before in 1934 in a slightly different way, but more or less the same thing. The first step would be for the Treasury to sell its gold to the Federal Reserve at whatever price they declare is the new floor for gold, let's say $15,000 an ounce. The Federal Reserve pays the Treasury for the gold at the market price, which is now $15,000 an ounce, let's say. That gives the government enough money to pay all the debt, all the expenditure this year and next year, and to reduce, or rather redeem bonds which are maturing without having to take out new debt. The Federal Reserve has now got the gold, the Treasury's got the money. The next thing the Treasury does is to buy back that gold from the Federal Reserve using what's called gold notes. Now, gold notes are not new. The Federal Reserve has already got a whole bunch of gold notes from the last time they went through this exercise. Last time the Treasury bought the gold off the Federal Reserve, they gave them gold notes. But the beauty of gold notes is this. They're not part of the national debt. They don't bear any interest, and they are perpetual. So if I borrow some money from you, and I give you a bit of paper saying I borrowed the money from you, but it's not part, I don't owe anybody anything because it's not part of my debt. So I'm feeling good. And then, by the way, I don't have to pay you any interest. And by the way, I don't ever have to repay you. I'm sitting pretty. So that's what the government should do. Now, the Federal Reserve is and can, and always has treated these gold notes that it owns as money, as an asset. So you've got two sides of the coin. Even though it's technically a liability of the government, it's not part of the national debt. And since it's never repayable, it's only redeemable if the government decides to redeem it. Basically, it's like a banknote. It's a worthless bit of paper. It's irredeemable with no interest. And the government's got, so the money's, when they've completed this exercise, the government's got its gold back in full. It's got the money. The Federal Reserve is still happy because it's got an asset, the gold notes. So its books balance. And we've got a whole bunch of money now sitting in the Treasury, which can be used to redeem the maturing debt as it comes up and to pay the ongoing expenses without having to borrow money for a year or so. Obviously, they might have to repeat this exercise in a year or two, but probably not, because the consequence of doing this exercise is it will create a shortage of Treasury bonds. So what happens when you have a shortage of Treasury bonds? The yields go down because everybody's still, the number of buyers don't change. So the buyers are still there, but the number of Treasury bonds have gone down. So what happens? The prices go up, the yield goes down. And because the yield has gone down, the problem with borrowing money when they restart borrowing money in 2 years' time of having to pay higher interest rates isn't there because the interest rates are that much lower. The yields are lower. So that if they were rolling over debt at 4.5% at the moment, they'll only be rolling it over at 2.5 or 1.5.
I think one of the pushbacks on that idea would be it sounds almost like an accounting trick, and that the consequences of this would be potentially, you revalue gold to 15,000. Well, what does that do with other prices, right? Don't other prices rise to match that, triple, quadruple from there? And all you're doing is really inflating away the debt. What is your perspective on that?
That's absolutely not going to happen. We've got lots and lots of evidence that it won't happen. The first and obvious bit of evidence is when they revalued gold upwards by 67% in 1934, beg your pardon. What impact did that have on prices? None whatsoever. Nothing. Didn't affect the dollar, didn't affect the prices, didn't affect anything. Likewise, we've had in the last couple of years a doubling of the gold price. Has the dollar halved? No. Have retail prices doubled? No. So the rise in gold to double the price had no effect. So why would a change in the gold price to triple the price have an effect? It probably would. I don't see why it would have an effect. The only and it won't change anything vis-a-vis the money supply. Of course, the government gets a whole bunch of money which it can spend, but at the end of the day, it was going to have to get that money anyway by increasing the debt. So it would have increased the debt, got the money, spent it anyway. So all they're doing is spending exactly the same amount of money as they would have done. What we've changed slightly is the short-term money supply goes up a bit, and the long-term money supply, which is the government debt, goes down a bit. So you just have a slight rebalance. But it's really, these days, government debt is as liquid as cash in the bank. So it really doesn't change anything about the total debt. It's not going to change the prices of anything except gold and silver.
Do you see that this would be a way to escape what we've talked about for so long, a currency crisis, a collapse of the U.S. economy? I mean, you have talked about how the U.S. debt situation is unsustainable. And even Powell said that the trajectory is unsustainable for where we are on that, which I thought was an interesting admission from him. But is this a way to actually, I guess, put the crisis to get rid of the actual crisis that we see in the future?
Well, it's a way of pushing it to the future and kicking the can down the road. And that's something which has been going on for 20 or 30 years since we came off the gold standard. So it is much of the same. So kicking the can down the road is a solution which is very acceptable to politicians because it keeps the economy going, everything stays stable, and everyone's a happy bunny. But we could eventually get into a situation where we're in a crisis. Nobody trusts the currency for whatever reason, some internal disaster, maybe a natural disaster, maybe a political crisis, and then more drastic actions needed. So the more drastic action would be some kind of currency reset or currency controls. And the way that would work would be by some sort of alternative currency being issued in whatever form. So, as an example, in the UK after the Second World War, the form was ration coupons, where you couldn't, it wasn't the same thing that it is now, but you couldn't spend your money unless you had a ration coupon to go with it. So what was the real currency? Was it the ration coupon, or was it the money to buy the pound of butter? So you might have enough money to buy 5 pounds of butter, but if your ration coupon said only 1 pound of butter, that was it. That was what you're going to get. Unless you sold your ration coupon on the black market, in which case you get a very good price for it for someone who wanted 2 pounds of butter. So what's the real currency? Now, today, perhaps we're not talking about ration coupons or maybe not even capital controls. We're perhaps talking more about some kind of alternative currency which has to be used, such as the central bank digital currency, the CBDC, which becomes, for whatever reason, the unit which you have to use when you are transacting, whether you're buying capital assets or whether you're spending it on your shopping. So if all transactions have to pass via a CBDC wallet for anti-money laundering reasons, for tax reasons, for anti-terrorism reasons, these were the reasons you're given by the government, then it's very easy to one day say, all money still has to pass via your CBDC wallet, but there's a restriction on how much you could take out of your bank account to put into your CBDC wallet at the moment, because we're in a national crisis. And then effectively, you slowly but surely, or very quickly, find yourself running the entire economy on the CBDC instead of running it on the money which is all around in the banks. Of course, there's going to be a lot of rules and bailouts and all kinds of things. But at the end of the day, the government is leaving behind its debt in a currency which effectively can't affect the economy anymore. It's a defunct currency because the new currency is the CBDC. Even if for a long period you were able to change it one for one, what happens when the day comes when you can't change it one for one? We're back in 1933 all over again, where $20 was an ounce of gold was $20, and suddenly one day it's not.